we'll start farthest away from the empty chair, and he'll get here in a sec. I'm Barney Schaubel. I'm a partner at Nephila, which is an investment platform dedicated to weather and catastrophe and other kinds of insurance and reinsurance risk.
I'm Matt Weber. I used to be the Chief Underwriting Officer of Swiss Re and probably committed a big number of crimes related to parametric covers myself and with my people. I stepped down from my position last summer in order to be able to move to California. And given that I'm in California, my company asked me to continue to work for Swiss Re as a senior advisor, which means I can wear the clothes whatever I want. And in addition to that, whenever somebody at Swiss Re has a problem that could be addressed by means of tech, I try to find a startup or a university that offers a solution that addresses the problem which somebody at Swiss Re has, which is why I'm here.
My name is Dan Brown. I'm a partner at Drinker Biddle. I am based in San Francisco, and I'm at Plug and Play quite often. I do some of the advising here. I do all regulatory work. I'm not a coverage guy. I'm not a litigator. I do regulatory compliance and M&A. And so in this space, I just advise folks on how to get InsurTech up and running and compliant.
Sorry about being late. I'm Ted. So I realized we're talking about the metric system. I thought we got rid of the metric system about 40 years ago when they first tried that here, but I guess we're talking about it again. Just kidding. So I was busy doing a quick recording for the Plug and Play, so I'm sorry I'm late, but I'm looking forward to the discussion today about Parametric. It's something that we don't do a whole lot of in the U.S., but I think there's some opportunities there. And it's something that I've been fascinated with in some of my travels and some of my discussions as we've done bilaterals with other countries around and other regulators from around the globe.
Yeah, so some of you, just from talking to you casually today, may not actually know what parametric insurance really is. So I thought we'd spend a minute just on that to set the baseline. So parametric insurance has actually been around for a while, and there's very complicated models on this stuff, but it's been rediscovered, and our panel today is really kind of discussing why it's been rediscovered and why it's kind of the next big thing. So in a nutshell, parametric insurance is a type of insurance which the payouts, if there is a event, is based on a predetermined trigger, such as in a hurricane or earthquake, whether that particular natural disaster met a certain strength or threshold number, which is pretty objective to figure that out based on providers of who rate the hurricane or earthquake strength. And so traditionally it has been used more in the natural catastrophe space. So the payouts that are usually made are quite formulaic as well. And so this lends itself to the potential of having this type of insurance be more popular for purposes of smart contracts and blockchain type of structures that we discussed earlier. So that's the reason why this has become a little bit more in focus in the insurance industry as to whether new technology is enabling this parametric insurance to be used more widely. So anyways, that sets the stage, and I'm going to ask some questions to the panelists then to have them sort of describe what their views are on this. So the first question for the panel is, when and where do parametric insurance covers make the most sense, and where or when do they not? So maybe Barney, you want to take that first?
Sure. So I had the pleasure of working on one of the first parametric catastrophe bonds, which was cleverly called Parametric Re, in 1997. And we at Nephila, and I in my life prior to Nephila at Goldman Sachs, worked on a lot of these contracts. The situations where they make sense are where indemnity insurance is very difficult to execute. And that could be for a couple of reasons. It could be because you're dealing in emerging markets where it's difficult to send somebody out to ascertain the physical condition of a building or a crop, and you can measure remotely. Here's where the earthquake was, here's where there was or was not rain. So using, particularly now, new technology and sensors to try to settle claims swiftly makes sense. The second case that we think it makes sense is around difficulty of claims settlement. So, for example, in the catastrophe bond space, the kinds of companies that have used this sort of trigger tend to be those with very complex risks. You have a railroad, or you're the New York subway system, or you own a theme park, and rather than trying to model and parameterize the specific loss, you can say, I know that if I have an event that looks like this in this area, this is going to cause me to lose money. Or it could be in the middle of the Atlantic Ocean, what they call cat in the box type of coverages. And the third place is where you just don't have any coverage today because people aren't sure about how to model the risk itself, pandemic, where you can characterize that risk roughly or bluntly by using some sort of trigger. Where it makes less sense is where you have a good indemnity answer. The biggest difficulty for buyers for parametric insurance is the uncertainty around their recovery, the mismatch. You have a house that happens to be impacted by an earthquake, but the earthquake was a 6.9 and not a 7.0, and you don't gain protection, and that's very difficult for you as somebody who spent that money. And the second is a regulatory question, which I'm glad that we'll talk about that a little bit, which is a parametric contract in a specific country, in a specific space, is it an insurance contract? Is it a derivative contract? Is it a little bit of both? And you get wildly different interpretations or answers to that question and different interpretations of that regulation depending upon where you are in the world and how it operates. So in the right places, it can be a very powerful tool. It can certainly enable protection where there isn't protection now, which is important. But as a substitute for existing indemnity coverage, or in a situation where you're really talking about sensitivity to mismatch risk, retail, for example, or homeowners, not businesses, I think it can be a lot harder.
So can I follow up on one of the things that Barney said, and it's a subset, and I'd be particularly interested, Ted, in your views on this, because let's follow up on the earthquake example, and let's say there's a parametric product that says if there's a 6.0 earthquake within 3 miles of your home, you get some amount of money. I think that makes a ton of sense to use parametrics if you're talking about small amounts. If you're talking about a primary home coverage, right, where that could be millions, I think that makes less sense. I think that's more of a let's get adjusters out there and figure it out. But if you're talking about small amounts, then yes, if there was that trigger near your house, you probably had some expenses. Let's move on with that. Does that sound reasonable, Ted?
Absolutely, and I think that's where some of my interest has been piqued by some of the work being done in Southeast Asia to get consumers who've maybe never had any sort of financial protection before through a public-private partnership perhaps where the government is going to subsidize the insurance premium, if you will, to some extent, and then have the consumers pick up some of it to provide them a small but very, for them, important benefit should a catastrophe occur. So if the tsunami or the typhoon hits the beach, depending on how far you are away from the shore, you're going to receive an automatic sum relative to your distance from the event. So that's where I think it's important to get that sort of model engaged to provide people who may not have discovered or may be in a less sophisticated insurance marketplace such as what we have here, some settlement or some bit of relief post-catastrophe. So that's where I see this adding a lot of value, but I think moving forward, there may be, again, given the amount of data that's now available, given the types of algorithms and the artificial intelligence, some of the analytics that we were presented with regards to some of the startups, there might be some new thinking about how data can be used to provide a parametric benefit for consumers even in the U.S. As more and more data is collected, as more and more data is available, there may be ways to leverage that to provide that sort of, and I know we're kind of talking about at some point, what does the future look like? But there's a possibility even for more developed countries to have the ability to provide that sort of benefit for consumers based more on a triggering event than the actual traditional loss adjustment company check, but have it being done more immediately. And I think the other piece that's really important with regards to this type of way for consumers to get relief is really the ubiquitous now throughout the world use of cell phones, and those benefits can be the individuals can be tracked. Those benefits can be shared through the cell phones. I mean, it's just a lot of very interesting things going on around the world with regards to this type of coverage.
Maybe from my side, I would like to add, without repeating what Barney said, I think these were all very, very good examples. Maybe just two more examples where parametric covers do make sense. One is, if a policy is really small in size, the costs of adjusting a loss and settling a claim might become prohibitively expensive compared to the total amount of risk transfer. Keyword microinsurance, for instance. In such a situation, I also think parametric covers do make sense. And the other example I would like to give is there are situations where the insured is in a position to settle or to determine the own loss. This is often the case when the insured is a governmental entity, whereas one side or one governmental entity incurs the loss and another department determines how big the loss is, the Department for Statistics, for instance. And in such situations, the insurance companies like to use parametric covers and not indemnity-based covers. Maybe, Paul, allow me to add something you said. In order to prepare for this panel, I Googled and went into Wikipedia to inform myself what the heck are parametric covers in insurance. And I learned it's usually done related to natural catastrophes and in some markets related to agriculture. And you also implied this. And that's correct. But if you think about the definition, something happens, a trigger event happens, and then a pre-agreed amount of money is paid out. If you take this literally, you come to the conclusion that parametric covers are actually much more spread than just within the area of Nat Cat and agriculture. Example, life insurance. A breadwinner of a family passes, it's the trigger event, and then the sum insured, which is the same as a pre-agreed amount of money, is being paid. The purpose of this is to provide liquidity to the rest of the family until they can establish a new breadwinner to deal with the situation. The purpose is not to try to estimate how much income would the deceased have generated during the rest. It's just a pre-agreed amount of money in case something happens. That's a parametric insurance cover. Other example is hospital cash. Somebody needs to go to the hospital, receives a certain amount of cash in order to get admitted. Or critical illness, these are all parametric covers. So in a certain way, they are much more common than Nat Cat. You could even make a point that in space insurance, the whole premium, or 90% of the premium is earned during the first 5 minutes after liftoff of a rocket. You could say, well, either the rocket survives the 5 minutes or it doesn't. If it doesn't, it's a total loss. Boom, parametric payout.
Yeah, so on that and following up on that, question for Barney then, in terms of Do you agree that parametric insurance could have this wide application? And then maybe for the wider group, then why, parametric insurance has been around and these models have existed. Why is it now that people are focusing on this simplified form of insurance cover?
Well, I think most people here agree that the insurance industry hasn't been fantastic about rushing to new and more efficient ways to do what they've done, right? So I think there's a lot of core inertia. But I agree with Matt's because in a lot of ways that reputation is undeserved. If you look at space or if you look at weather derivative contracts, which are effectively parametric contracts, or credit default swaps, which are effectively parametric contracts in a different way, this consideration of trigger structure for risk transfer has been popular. The difficult part in developed economies, if you look at flood, for example, people who are used to being paid, here's what I lost, I want compensation for that dollar amount of loss, it can be difficult to say, well, here's something which is a little bit more crude but has other advantages, like speed of settlement, for example. Where you've seen a more assiduous adoption has been either new risks. You're building a wind farm, you want to make sure that the wind blows, you want to buy protection against low winds. That doesn't exist right now, so you can parameterize that, and that's a kind of protection that we offer, for example. In new fields, that's what it takes. If you're going to micro-insurance, if you're going to Southeast Asia, if you're going to farmers who only have the multi-peril crop insurance program, but that doesn't cover cranberries or vineyard grapes, it's tended to be adopted in areas where there's a risk that isn't already addressed by the market. I think a lot of the struggles have been if you're trying to substitute parametric for something that's already there. That's a much more difficult proposition.
Another reason that I think this is very popular now is kind of the overall affluence of our nation and a desire to really get full protection. And here's my example is going to be in the health insurance industry because folks tend to not think of parametrics there. But we have what we call the ACA, Obamacare, and you should have that. You should have full coverage. But especially if you are affluent, you might realize that you're going to get dinged with a lot of deductibles. So you might want to buy a fixed indemnity policy. And what's that for? It's not for your primary coverage, but if you have to go to the hospital, you're going to have deductible, you're going to have expenses, so you want that covered as well. Is that marketable for everyone? Probably not. I've had that friendly discussion with regulators and legislators quite a bit, but that's parametric. You went to the hospital, here's $50, whatever it is. And I think it's that we're trying to eliminate even that small layer of risk at a personal level.
And then I would just go back to what I rambled on through with my first statement is that the reason why I think it's becoming more and more popular, or there's more opportunities for parametric to enter the marketplace is the advancement of data and of technology. We've got the Internet of Things now. We've got more and more data available, better ways to mine it, better ways to understand it, better ways to locate it, and those data points can be those trigger points which ultimately result in more quick payment under a parametric scheme. And then, of course, you've got better measurements of weather, better measurements of natural catastrophes, hurricanes, earthquakes, et cetera. So I think with that confluence of technology, the confluence of more data, the time is ripe now for more focus to be placed back on the original ideas of parametric with a lot more accuracy and a lot more predictability built around it.
Just one other note that's a factor as to why the speed of adoption has potentially been slow. At the core of insurance is this principle of indemnity. And there has been a lot of concern in certain places, particularly regulatorily, around if you extend this and now you say, well, let's agree if it rains later, you'll pay me, and if it doesn't, I pay you, and neither of us is particularly financially or emotionally invested in that rainfall, is that gambling? Is that the sorts of contracts that now stray out of the realm of protection? And there are many cases where it's obviously not, but there are edge cases where it starts to move in that direction. There's been an understandable concern on behalf of regulators and rating agencies and others to say, well, what's the right amount of alignment? And if you hedge your oil price exposure by hedging in the liquid oil futures markets, it's not an exact match, it's close enough. But if you bet on my life, not on your own life, that's obviously illegal, or at least in most states, I think it's illegal. So, that becomes a thornier problem. So it's worth noting that at the edge of insurance where it strays into gambling or tontines or other things that you've had bad experience with in the insurance market, that's also been, one of the factors that slows adoption.
I think the fact that innovative people and innovative companies have started to move or to have decided to start the insurtech movement almost automatically leads to the proliferation of parametric covers. What do startup companies try to do? They attack the big traditional companies such as Fila, for instance, and Swiss Re, a little bit. They look at the value chain of these companies and try to focus on those elements of the value chain where they feel they can significantly improve it. Let's quickly look at the value chain based on traditional insurance company. First, the reputation. Is there anybody in the room who thinks an insurance company has a fantastic reputation? Right? Most people would agree that the reputation sucks, despite the fact that if you think it through, insurance is one of the most social things that do exist, and insurance, different to most other social experiments which have failed, insurance does work, and it's the basis for economic progress, etc., etc. But the reputation is bad. Why is it bad? One reason is indemnity-based covers say, we cover your home, but we exclude. And then you go through the policy and you read, you know it better than I do, 5 pages of exclusion, right? Earthquake is excluded, your car is excluded, if you have artwork it's excluded, jewelry is etc., etc. It's excluded, and at the beginning it stands, we cover your loss. A parametric cover is formulated, an earthquake happens in an area of 10 miles around your home. If it's greater than magnitude 6, we pay X. That's a positive formulation. It could be that the area of coverage of the parametric one is significantly smaller than the indemnity-based coverage would be, but still it's a positive experience. If this and this happens, then the insurance company pay. Secondly, claim settlement quicker. It was mentioned already. I'm not going to repeat it, but very, very important. Right now, when a consumer pays $100 for a policy, the consumer on a PV basis over time gets maybe $50, $55 back. That's not a fantastically good product, right? Pay me $100 now and I give you back a little bit more than half of it. What the heck? That's not good. So we need to reduce the frictional cost ratio, and parametric products allow to do this. So if you think it through, it's absolutely no surprise that now is the time to think about which traditional covers can be replaced by means of parametric covers.
And you foreshadowed, and other people have foreshadowed this next question, which is really bringing it back to some of the plug and play cohorts. What's your view then on what actually would work, or what types of parametric insurance products or parametric insurance structures would work for startups who are trying to enter into the space, and whether that would be something that could challenge the incumbents?
Basically, let me first say what doesn't work. If an accurately determined financial loss incurred is absolutely important, then parametric covers do not work. on the basis of this, I would say most liability losses, for instance, are probably, these are not fantastically good candidates for parametric covers. I also like to think whenever in the determination of the loss, lawyers and judges are involved, maybe it should be indemnity-based and not parametric-based. If, however, speed of loss payment is important, if it's important to keep the costs down, these are typical examples where the startup companies should concentrate, and I'm sure they will concentrate on these areas.
And I think a third area, and it's one that Barney mentioned, that you should focus on is demonstrating to regulators that there's no better way to arrive at the losses, right? This is sort of a, if you think of contractual things, it's liquidated damages. We know something's going to go wrong and you're going to have some damages, but this is the best way we can agree that's what the damages are.
And I think we had a presentation earlier today from a prime example of it, travel insurance. I mean, we've already got the data. You can tell when the plane's not going to make it. You can tell when the plane's late or the flight gets canceled. It's all very available information. You just figure out if the guy's got a ticket. If he's got a ticket, immediately you can wire or transfer some funds for that entity. So I think, to what my colleagues here said, it's those kinds of very bespoke situations where you can figure out, using data or using some other very easily determined information, that the loss has occurred, something's been disrupted, and you can immediately identify the individual who has the coverage and get the funds to them.
I would like to make a statement involving regulators, just to spice the discussion a little bit up, if I may. So from my perspective, if we have fantastically good regulation, that's also fantastically good for innovation. If we have bad regulation, the innovators can still deal with it. After all, the minds behind innovation, they are innovative, so they will find ways to deal with the regulation in a fully compliant way. What is really killing innovation is regulatory uncertainty. And I would like to show you a very quick example which I have experienced myself. Approximately 13 years ago, we maybe were a little bit ahead of our time. We had the idea we could offer a cat-in-a-box type product, which basically means if in an area around your house an earthquake with a certain magnitude happens, we pay X. So nothing special in the personal lines market segment in order to allow the insured to supplement the indemnity-based insurance, which typically has a big deductible related to earthquakes. And we thought at the time we would distribute it through the internet. So we spoke to a number of regulators, some of them also in states with a lot of sunshine, presented the idea, and the reaction of the regulator typically was quite positive, and they said, wow, that's really cool, but is it admitted insurance? No way, it cannot be admitted insurance. Well, is it non-admitted insurance? For you, in order to be able to sell non-admitted insurance, you need to have 3 declinations in the admitted market, but you cannot go to the admitted market with a product that is not admitted insurance and everybody sees it. Then the question is it even insurance? Well, we are not so sure. Maybe it's a financial derivative. You don't want to sell financial derivatives to individual people, and you mentioned it. And what about gambling law? You could lose money, you could win money. Does gambling law apply? So all legal and regulatory uncertainty, and that's when we pulled the plug, because it just inhibited innovation. I understand that today a number of these questions have been recognized, and some of them are being addressed, and that bodes very well for innovation.
I'm really sad that FINMA treated you that way. sort of international joke. Sorry. So I, I figured. So I think, and I think that this kind of brings us back to where we are today. I think a lot of things have changed. I think there's a lot more recognition on the part of U.S. regulators that the environment is changing, that innovation and technology and new products and new ideas are entering the marketplace. I'll give another shout back out to the NEIC, which supports us as state regulators in coordinating these new kinds of ideas and presenting them to us either through their own presentations or having companies with innovative ideas come and present to the regulators to get them comfortable with new ideas in the marketplace. So I think 13 years ago was a problem, but I think if we look fast forward to today, I think we're at the edge of a lot of changes going on in the insurance marketplace. I think there's going to have to be more principle-based insurance regulation going forward, not just the existing rigid regulatory framework. And we should be open to new suggestions and not figure out ways to say no, but try to find ways to get to yes.
Well, with that said, we'll let the regulator have the last word on the formal part of the panel. Do we have time for one question, if anyone has it?
Insurance for life insurance, you alluded to that. I'm curious to know what your thoughts are on parametric insurance for health with regard to a specific outcome, such as coming down with a specific disease or set of disease.
That's also something which exists already in some markets. For instance, in a big number of Asian markets and for instance also in the UK, there is a coverage called critical illness. It pays if somebody is diagnosed with cancer or Alzheimer or a cardiovascular disease, he or she gets a pre-agreed amount of money which allows him or her to go to the hospital and start the treatment immediately, because for some illnesses it is really, really important to be quick and not wait too long. And this type of coverage, for instance, was invented in South Africa, so in an emerging market, where a famous surgeon, Professor Barnard, was the first to make heart transplant surgeries. And in connection with these type of surgeries, also the critical illness covers were developed and determined. And to me, that is a fantastic application of the parametric insurance. Think of a situation where somebody needs a kidney or a heart very, very quickly, and then a dispute starts, who should pay and how much, etc. Would not be good.
Yes, there is. Federal and state levels.
Unfortunately, we have absolutely no transparency in what procedures cost in the U.S., which is another whole day's worth of discussion on healthcare cost containment, which we need to have a larger discussion of in this country. But if we had some sanity around the cost of healthcare and some transparency about what different procedures cost, and we could convince the medical community to take $10 for an ACL repair, $20 for a heart transplant, and we could have some bundled transparent pricing around some of these things, then I think the idea has even more merit, because then you know what you're paying for. But again, I don't want to have a speech on healthcare costs and healthcare reform today. But that is one of the big issues that would cause difficulty in moving that model forward.
Well, that was a great question. So let's thank our panelists.